Hello, my name is Dawit Kebede, Senior Economist at America's Credit Unions, and welcome to the Economic Update. I'm here to walk you through our updated economic and credit union forecast. What does our forecast look like? Moderate growth, stabilizing inflation, and a resilient but cooling labor market. The main reasons are AI-driven investment, tariff effects that have been less severe than expected, and a strong consumer spending. But we still face big uncertainties like Fed policy changes, a pending Supreme Court decision on tariffs, and geopolitical risks. Over the next couple of years, we expect the economy to grow at about 2%, right at the long-term trend. Growth this year may come in slightly higher at 2.2%. A few factors are driving this. The new tax law will likely provide stimulus through refunds and investment incentives. Fed rate cuts are helping on the margin, and AI-related investment continues to boost business spending. Consumer spending remains strong, but is mainly driven by top earners. Whales effects from stock market gains are doing a lot of heavy lifting. However, another year of S&P 500 gains like we saw last year is unlikely. That means the whales effect may fade. This is the K-shaped economy at work, with stock market performance driving consumption more than broad income growth. Inflation currently sits at 2.7%. We project it will fall to 2.5% this year and 2.3% in 2027. The impact of tariffs is less severe than was feared. The effective rate is around 11%, much lower than what was announced last April. Research indicates there is a gradual and steady pass-through of tariff costs to consumers, and that's expected to continue during the first half of the year. If the Supreme Court rules the tariffs illegal, that would help further reduce inflation. One technical note, the October government shutdown affected CPI data as the Bureau of Labor Statistics assumed zero inflation for most goods that month. This will distort year-over-year comparison. Unemployment is projected at 4.6% for both 2026 and 2027. There is more uncertainty around 2027, depending on constrained labor supply and how AI impacts labor demand. Job growth has slowed significantly. The economy added an average of 49,000 jobs per month in 2025. In the second half, that dropped to just 15,000. On top of that, AI is already affecting some jobs. New opportunities will emerge, but where they come from is still unclear. We expect the Fed to cut rates once this year and next year. That would bring the Fed funds rate to 3.4% in 2026 and 3.1% in 2027. We do expect changes as to who sits on the FOMC. Of course, Fed Chair Jerome Powell's term expires in May. This matters because appointments to the FOMC could tip the balance towards additional cuts. The 10-year Treasury rate is projected at 4.2% for 2026 and for 2027. Government borrowing will put upward pressure on rates. Geopolitical tensions could also reduce foreign demand for U.S. bonds. Now let's turn to credit unions. Savings growth is projected at 6% for 2026 and 6.5% for 2027. That brings us closer to the long-run average of 7%. Several things support this projection. Stock returns are unlikely to match 2025, leading to more traditional saving patterns. Excess COVID savings have been depleted, removing a factor that had suppressed deposit growth. Declining rates will make money market funds less competitive, and higher tax refunds are expected this year. Loan growth is projected at 5.5% for 2026 and 6.5% for 2027. Auto loans from 2022 are being paid off, which suppresses net growth, but this effect should fade by 2027. In the mortgage market, rates need to fall to 5 or 5.5% to restart purchase activity, according to housing analysts. With mortgage rates likely to stay around 6%, the market will remain constrained. New car sales are running at 15.5 million units, which is below the normal 17 million. Like housing, high prices and rates are holding buyers back. We forecast delinquency to decline from the nearly 1% today. We expect delinquency rates to be around 0.8% by the end of 2027. Loans from 2022 and 2023 are the main driver of elevated delinquencies. Those older loans are plateauing and will age out. We anticipate charge-offs at 0.75% for 2026 and dropping further 10 basis points in 2027. The long-run average is 0.5%, so these projections are still high. But higher projected loan growth relative to previous years will also help lower these ratios. We expect return on assets to be 0.8%. Net interest margins are improving as older, low-rate loans roll off. Investment portfolios are repricing higher. AI is driving productivity gains, and employee growth has slowed to just 1%. Stepping back, we do expect this year to be better than we previously projected, with some uncertainties in the background. The labor markets will probably stay a holding pattern, while rates should drop ever so slightly. All of this combined means people will likely return to safer financial products, which should favor credit unions. That wraps up this month's economic update. Thank you for watching, and we'll see you next time.